We've seen two 25 basis point reductions year to date, and that's consistent with most economic forecasts coming into the year. So we obviously had the June rate cut, the July rate cut.
Yep.
And economists are basically saying there's a clear intention to continue to trim rates this year and into 2025.
It is good. Like if you borrow money, obviously it's going to be a lot cheaper. And I do think there is a huge part of this that's going to help in the sense that if you're in real estate, it'll save a lot of projects, make a lot of projects viable. And if you're in lending, there's be an opportunity hopefully to make more spread in some opportunities in certain deals. On a global scale, Canada, it actually like the reduction of our dollar is actually a good thing for Canada and for people here because it reduces capital flight, increases exports. It's a good thing in that sense. It's negative in the sense that it may still contribute to some additional inflation. So cost of living is not going to be great, but it'll keep the economy running. And so it's a time to basically, again, try to hold on to assets, live frugally, and kind of ride the wave.
Yep.
Thanks for tuning in to the Canadian Private Lenders Podcast, the show about starting a private lender in Canada, the mortgage industry, and the real estate industry. Your hosts are Neal and Ryan McNeil. Enjoy.
All right, everybody, welcome back. It's episode 44 of the Canadian Private Lenders Podcast with your hosts, Ryan and Neal. Neal, how's it going today?
Very well. A little tired, don't mind me, but things are good. Things are really good.
I meant to say off the top, exciting news. We've got a new sponsor of the podcast.
We do.
This episode is being presented by our partners at Mortgage Automator.
If you haven't heard us talk about them enough.
Yes. We're going to continue hyping them on here because they're worth it. It's been an amazing partnership for us and super excited to have them supporting the pod.
If you're in this business, it's the be all end all.
Game changer.
But now, if there's another sponsor out there.
We're always open to chat. No, but just wanted to quickly say thanks to Joe and Pavel at Automator for the sponsorship here. And we're looking forward to continuing to partner with them and highly recommend any startup privates or existing ones that haven't switched over to go take a look at one of their demos because it's been, like I said, amazing for our business.
Yeah. If they're going to listen to this episode, I imagine, because
I would hope so.
They're going to send us a discount code to send to the listeners.
Yeah, let's that. Exactly. We've been piping them. They haven't sent us one yet for our business, so maybe we'll start there. But
that's a good point, actually.
No. It's been well worth it for us as an investment. As we've talked about many times, it really eliminates that admin burden. But Neal, what are we going to get into today?
What everyone thinks about, talks about, cries about, rejoices sometimes. Hasn't been rejoiced in a while, but the update on the Bank of Canada, where rates are at.
Yeah.
Again, if you listen to Master Keys, you've heard us whine about this way too much. Ryan and I have also had some predictions. I was a lot more scared to what was going to happen this year, and I've been pleasantly surprised. But I'm also realizing that what this means, what's happening with interest rates, what it means is not as pleasant. And so it's that now is my next concern and stressor. But it's not even stressor or concern. It's just try to be cognizant, right? Like when you have things going on, you want to make sure that you pay attention to this because it would be, I feel like they're obvious telltales of what's coming if you follow them. So anyways, we want to get into the reductions that have happened.
Yep.
And we'll probably talk about our predictions as well as what everyone in the banking world is predicting for the next year and a half. The charts I'm looking at right now are nice. If you're in real estate, you're like, I like the look of this.
It's interesting that we've shifted towards kind of this optimism here. I was listening back, going to edit one of our past episodes. It was only like 2 or 3 episodes ago before the July rate announcement. And we had basically kind of assumed there wasn't going to be a rate cut for July based on the news of the day, that given day. And then within 2 or 3 days after that, the news had clearly shifted that, there's obviously going to be another 1/4 point rate cut here. And I mentioned it because it's been such an unpredictable year and a half here, but it does seem like there's some momentum now heading towards, because we're kind of seeing, like you mentioned on this chart here, Neal, we're seeing some pretty close to consensus from the big five in terms of where rates are headed from now until the end of 2025.
This is a pretty tight set of lines. Well, I mean, we'll get into it here in a second, but there's a bunch of things that still spiral in my head.
For sure. So I'll set the stage here, okay? So what we know so far, we've seen two 25 basis point reductions year to date, and that's consistent with most economic forecasts coming into the year. So we obviously had the June rate cut, the July rate cut.
Yeah.
And economists are basically saying there's a clear intention to continue to trim rates this year and into 2025.
Yeah.
Right? So what are your thoughts on that off the top?
I mean, I think it was fairly consistent. I think everyone said it was going to happen a lot later in 2024. That was kind of the idea in my head, was like, The first one would probably be in September, and it got advanced to earlier in the year. The sizes are what we expected. I feel like no one was like, yeah, they're going to take off 50 or 100 points off the hop. It's going to be these little ones. And I think there was a bit of surprise that two of them happened back to back.
Yep.
But ultimately, again, 25 bips is not huge. And we were having 50, 75 bit increases. So like we're really shaving off barely one increase in the last two decreases that we've had. So ultimately, I think it's showing good direction. I don't think it hasn't really changed much yet.
Yeah. And I think, some of the catalysts here, or at least maybe some of the assumptions that I maybe heard from you, Neal, or other in the news in the past, was that global forces might prevent Canada from cutting when maybe they should have cut, right? Because the U.S. hasn't cut at all yet.
Yeah.
And there's been other, areas in Europe and Japan that haven't cut, and Japan actually increased. And I think we're going to get into the global stuff in our next episode here, but for the purposes of today, I mean, obviously inflation data was trending in the right direction for a while.
Yeah.
Job data has been very poor. So both kind of leading indicators for rate cuts coming, right? And now we've seen that come through. So yeah. So do we want to get into what the big five are saying?
Yeah, we can. And I mean, kind of to your point, I think that was what I was alluding to earlier, is like the part that surprised me is how soft the Canadian economy is. And that's kind of what this is an indication of, right? So that's what I'm like, as much as I get excited to see rate cuts because real estate based, and I'm sure a lot of listeners are, so that part, you're like, oh, sweet, rate cuts. But that also means that they're doing that because the economy is hurting, right? They did it originally with COVID.
Sure.
Because there was a lot of concern that the economy would collapse.
Yeah.
And prior to that, the economy was going slower and slower. So they kept completing these cuts. So again, as much as it's a nice relief, it shows where things are.
Yeah.
And rate hikes was an indication of like the market was crushing it.
Yeah.
Like the economy was crushing it.
For sure.
From their perspective. So I just give my little negative sentiment and all.
Yeah.
But on the positive side, it is good. Like if you borrow money, obviously it's going to be a lot cheaper. And I do think there is a huge part of this that's going to help in the sense that if you're in real estate, it'll save a lot of projects, make a lot of projects viable. And if you're in lending, there's be an opportunity hopefully to make more spread in some opportunity in certain deals. And the other thing was, and what I never really considered was, on a global scale, Canada, it actually, like, the reduction of our dollar is actually a good thing for Canada and for people here because it reduces capital flight, increases exports. It's a good thing in that sense. It's negative in the sense that it may still contribute to some additional inflation. So cost of living is not going to be great, but it'll keep the economy running. And so it's a time to basically, again, try to hold on to assets, live frugally, and kind of ride the wave.
Yep, absolutely. And it hasn't, these two recent rate cuts, obviously it hasn't been that long yet, but we haven't seen major stimulus to the market. It hasn't set the housing market on crazy. Like we were talking about that, like our concern, probably back in March or April, that, as soon as we get a quarter point cut or 50 beeps cut, the market's going to go crazy again. That hasn't happened.
So it's funny you say that. I'm just starting to see articles now talking about how house prices are growing again. And there's areas in the country that are starting to pick up pace, but they haven't gone crazy by any means. Sure. But I think, like, being more in the market, I'm feeling a bit of a pulse coming on. And I think if there's another rate cut in September, especially if it's like 50 bips, like if that happens, I think you will start to see it because you're starting to see 5-year insured rates as low as like 4.25%.
Right.
Which is really reasonable.
Yeah.
Combined with the, we talked about this a couple episodes ago, but the 30-year amortization on new construction purchases. And so again, I think new construction is going to do well starting at the end of this year and rolling into next.
Yeah, hopefully. Costs are still so high though, right? So it's hard to say.
Yeah.
Who's going to be able to afford that? You need, $150K family salary to afford the average, new build price these days. But yeah, just you mentioned about the potential September cut, and I think we mentioned before, some analysts are saying, the cut is coming. It's just a matter of how big it is.
Yeah.
I would be surprised if it's 50 beeps, given we've already cut 50 year to date.
Yeah.
But I did see in the US, the markets have already baked in that there's going to be a 50 basis point cut in the US in their September.
I heard that. Yeah.
Right.
The States is expecting that they're going to need to start cutting.
Yeah.
And again, all of this stuff has such a delay, right? It's like they say it's about 18 months before you start seeing the impact.
Yeah.
And so we're at that point now for the increase. And we're just kind of entering that, to be honest.
Yeah, great point. And I think, now that we're seeing still some sluggishness in the market, despite some of these rate cuts, I think you're seeing that lagging indicator in the market, right? Where maybe we did overshoot And despite the fact that the overnight rate's gone from 5 to 4.5, it's not necessarily re-stimulating things. And maybe that's a good thing for the time being.
I think it might actually make sense at how quickly they're doing this, because they increased rates so quickly and now they're bringing it back down. It might be like we've had basically a stall of transactional volume and money movement because of the cost. And that's stalled out for whatever it is, 6 to 10 months. And now they're going to bring it back down. And so when the real what the people consider the hard hit of increased rates would be, which is in probably the next 6 to 8 months, hopefully rates will be low enough then again to hopefully save and kind of re-stimulate almost immediately, right?
Yep.
Like, I think the point where it becomes too long and the over hiking is when people are just in a position where like, I can't get out of this now. Like, rates are 9%. I'm completely screwed.
Yep.
Versus I think a lot of people were able to kind of drag through it. And now like a lot of people will be coming up for renewals in the next 12 months and rates will be back down and they can be, you know what I mean, able to kind of get through it. But it stalled up a lot of transactions for maybe a year, which helped to cool things off a little bit.
Yep.
It might actually be, I'm trying to be benefit of the doubt here. Like,
we'll see.
They might have it locked in. It's a hard thing to predict.
I've been in the private lending game for a while, and let me tell you, Mortgage Automator is the ultimate software for private lenders. It's been a total game changer for our business. I've scaled 2 private lending companies, and I couldn't have done it without this software. The Mortgage Automator team truly understands the challenges we face, and they're constantly thinking ahead. For example, they've developed new anti-money laundering and know your client tools to keep you compliant with the latest FinTrack regulations, and their platform is SOC 2 compliant, ensuring your financial data is secure. This software eliminates almost every admin burden you can think of in the private mortgage business, saving us thousands on staffing costs. No more manually typing term sheets or tracking files in Excel. So whether you're a new private lender looking for an efficient solution or an established lender aiming to scale up, Mortgage Automator is a solution for you. See if Mortgage Automator could be a good fit for your unique lending needs at www.mortgageautomator.com/switch. Why don't we run through what the big 5 are predicting for, let's go through the next 6 quarters. So maybe we can go back and forth here, Neal, from Q3 of 2024 to the end of Q4 2025. So I'll kick it off here. For Q3 2023, RBC and Bank of Nova Scotia are predicting 25 beeps are going to come off by the end of Q3. So that'll be on the September call. And the other 3, CIBC, BMO, TD, all stating hold for September.
Yeah. I mean, is BNS the only one that's saying?
RBC and Bank of Nova Scotia saying
RBC has a
quarter point. You want to take us through Q4?
Yeah. Q4, I mean, it stays pretty normal, but I'd say the most optimistic in here, BNS again has a cut. CIBC, RBC are showing, let me break this down. So CIBC has a half point cut
in Q4
of 2024. And then the rest are doing another additional quarter point. But again, like they're all trending in the same direction. TD and BMO are still a little bit higher overall. There's no major outlier here. Like everyone's kind of in agreement. And the difference of a quarter point, I don't think it's going to be the huge swing.
Yeah, absolutely. So consensus at the end of 2024 is that the overnight rate is going to fall to 4%. Started the year at 5%. That's a 100 basis point cut throughout the year.
And
we're halfway there right now.
It seems that based on this trend, CIBC is the most optimistic, honestly.
Yeah, I'm just looking at that now. So CIBC coming around to Q1 2025 says we'll be down another 50 beeps by the end of Q1 2025, down to 3.5.
Yeah.
Before the winter's over.
Yeah, they're definitely the most aggressive.
Yeah.
Doesn't sound like the worst idea.
No.
And then they basically say it tapers out in 2025, ending at 2.75% as prime, which is also on the lower end. Them and TD expect that, which is interesting because I from my perspective, TD and CIBC, I feel like are some of the bigger banks.
Yeah. Well, RBC is number 1, right?
Yeah.
And I actually don't know what the order would be behind that, but I think TD is probably number 2. And then I think BMO's the smallest, if I'm not mistaken, in terms of AUM. But
overall, again, there's never a major spread. The only time that you see a little bit here is BMO. Again, BMO's almost like the least optimistic. And at one point there, like Q3 2025, they're 75 bips above CIBC and TD. So those CIBC and TD think by Q3 2025 we'll be down to 3%, whereas BMO feels like we'll be at 3.75.
Yeah.
Which that's a notable difference.
It is notable. Yeah, that's interesting. Maybe that's because BMO got downgraded a couple of weeks ago. They're trying to hedge their bets. Just crushing BMO recently. Yeah, so just to summarize here, end of Q1 2025, consensus at overnight rate 3.75. By the end of Q2, 3.25. By the end of Q3, 3%. By the end of Q4, 3%. And a couple banks, notably CIBC and TD, say it'll be at 2.75.
Like this is quick. Like when you think about like we're already in like effectively Q3 here.
Mhm.
We're talking 12 months out. Like I mean, I think very quickly I'm still hellbent that you're going to see a resurgence on the new construction market, because that means by like honestly you're going to start to be able to put contracts out this coming spring for homes closing in the fall of next year, and then you're going to have like 3% rates. Combined with a 30-year AM.
Well, maybe not 3% rates, but
I mean, they're 4.29 now. So if you have 2.25
fixed on a 5-year fixed,
5-year fixed, 4.29 is the lowest quoted rate right now.
I don't think so.
100%. I saw it yesterday.
I think you're off.
Look it up right now.
That's a discounted rate.
I was reading an article yesterday.
Are you sure it wasn't 5.29?
4.29 on everyone's at like 4.49, 4.69, and then there's one offering on these websites. It's 4.29.
I think you're looking at 3 years.
I promise you.
Okay, you're gonna have to.
All right, I'm pulling up right now.
You're gonna have to pull some sourcing on this.
5-year fixed. It's gonna be insured, of course. Uninsured's like a point higher than that.
Got it. Okay, that's why. That's because I was looking at uninsured rates.
Okay.
Yeah. So you're talking about
True North Mortgage has got rates from 3.99. It says.
So you're talking about high ratio stuff where you have to pay CMHC insurance on it.
Yes.
Okay.
Yeah. All these low rates that I'd be quoting would be all CMHC based products. So a 30-year AM and all that would be on a CMHC product as well.
Yeah. Okay.
And 90% of the purchasers on a new home in these open.
Fair enough. Okay.
You know what I mean?
Yeah.
Uninsured would be 5.29. Yeah.
Yeah. Okay. All good. We're back on the same page here. So,
anyway, but the insured products by the end of next year will be in the 3s.
Yeah.
And you'll have a 30-year AM.
Yeah. It becomes more palatable at that point for sure. And, obviously we need it, right? So
a 2-bedroom's $3,000. So the house might not be so far off the mark.
Yep.
I don't know if the resale market, like I don't know if the differences they're trying to put into the mortgages will impact the resale market versus the new construction market as much as they're wanting. Because right now it's just a 5-year difference in AM.
Yeah.
But
we'll see. It'll still make a difference.
Yeah.
With the monthly payments, right?
100%.
Yeah. Just a couple questions before we wrap here, Neal. So how do you think this is going to impact, let's talk balance of 2024. How do you think it's going to impact the Canadian market for this year nationally?
I think it's giving a little bit more confidence in it, but like I still see the articles every day that the Toronto investor market's completely dried up, and ultimately these rate cuts aren't coming down fast enough for the investor market to be able to make sense of their investments.
Sure.
So I think that's going to remain quiet, and I still think there's pain in the water for the investment market to come.
Yeah.
Especially because where these are impacting the investment market is people who are in the middle of projects right now that they're going to be getting closed out.
Sure.
They're going to be able to lock in at a more reasonable rate, which is great. But I think there's also a lot of inventory coming on, which ultimately, if they're able to lock in at lower rate, they'll be able to offer a lower rent, which is good. But I think it's going to impact the overall marketplace. So again, I'm not super bullish on the commercial side of it being beneficial. And then I think for single family homes, I don't think it's going to have a huge impact. It's giving some confidence though. So I don't think the bottom's going to fall out of it. Like it seems like there's still like pretty consistent volume. It's just not gangbusters like it has been for the last 4 years.
What about locally here in Halifax and Atlantic Canada? So we haven't seen the same price corrections as BC or Ontario. So do you feel like this is just in time for especially Halifax here where prices went up so much? Or do you still think we're going to see some sort of correction?
No, I think it's just in time. I think correction on the commercial side. We have a ton of inventory. Like there's a crane going up everywhere. I cannot believe. And there's still more buildings being started. And that's, I think, part of the problem here is these lower rates are giving a lot of confidence to builders to start again. And I'm not convinced that the housing shortage here is as bad on the apartment side anymore as it's been made out to be. I think it's more on the actual home ownership side of things. So I think locally, the housing market will continue to do well. You're still seeing things sell. Our average is still 101% of sale price. It's just a little more nuanced. And like a lot of people trying to sell homes that were overpriced are getting beat up a little bit. But if you're within the right price target and you're close to new construction in the value, I think you'll do fine. So I think Nova Scotia is actually going to outperform. They already are outperform a lot of the other provinces
for sure.
So
just to wrap up here, what about when we get to, let's talk late 2025, when we're at an overnight rate of 2.75 to 3 as per most of the consensus from the banks here? That's a significant difference from where we are today.
That's huge.
Right? So where are we? Let's get your crystal ball out, Neal, and predict where we are 6 quarters from now in late 2025.
Rate-wise or market-wise?
Market-wise.
Market-wise, my prediction is, like I was saying, I think Nucon's going to do really well. And the main reason being, there's also a ton of people that are in homes that can't make the switch.
Mm-hmm.
So it's not even a thing of like resale is just not going to be interesting. I think a lot of people that are in their homes can't get out of them. And then there's going to be incentives. There already are incentives for new construction. Additionally, the other part is you have a ton of new Canadians here that are renting that now are going to want to buy. They've been here for 2-3 years. They're going to have a down payment. They're going to have income history. The rates are going to be reasonable. There's going to be incentives to purchase. Combined with just culturally, again, a lot of these people that move to Canada are coming here to establish a life, and renting apartments not necessarily establishing a life for them. And a lot of the cultures from overseas are to own. You need to own your property, right? Rent is frowned upon almost. So I think with those kind of rates, it's going to make a ton of sense. Especially again, if you can get a house that's $700,000 and you're paying it's like $3,000 a month, but it's probably got 4 or 5 bedrooms. You can live upstairs, put a basement apartment. Like there's a lot of ways to make it work. Or like right now, a lot of people are living in a 2-bedroom apartment with 4 or 5 people. Why not take those same 4 or 5 people, if you've been comfortable living in a 2-bedroom for the last 2 years, pay a little bit more and go into a full-size home, which you guys now own. You're building equity. You're paying down a mortgage, a lot more space, like all these things, right?
Yep.
So I think once we get to this, I think it's going to be, I don't know if it's going to be like the doors are getting blown off, but I think it'll be moving fast. And I think an indication of that is if you drive around our city, the big housing developers that have been in the game for 50, 100 years are throwing up houses, brand new homes right now, like crazy.
Yeah.
And none of them are selling.
Yeah.
And you'd be like, why are they doing this? And I think they're doing it in preparation.
Yeah. Speculating. Okay. So let's put your prediction hat on here just before we wrap. If you were to predict, let's look at the residential side. National housing prices, end of 2025, is the average price gone up or down versus where it is now? And I'll give you a point. As of this morning on wawa.ca, average housing price $696,000. So call it $700,000. Do you think that's gone up or down by the end of 2025?
Oh God, that's down from where it was. Holy frick!
Yeah. The peak was 840 or something, wasn't it, or 880?
Yeah, it was
in 2022. It was crazy.
I think because basically I have to completely ignore Nova Scotia.
Yeah,
think about Ontario and BC
for sure.
And I think in Ontario there'll probably be good resurgence of volume.
Yeah.
But on the flip side, I think the investor market's going to get beat to shit.
Yeah.
I'm going to say up, but by a very small amount, because I think a lot of parts like Alberta will do really well. And I think the new home market and all the provinces will do well just because of all the new people. But I think the investor market's going to get destroyed as well, which is going to push it down. So I think like up 5%. Maybe. Okay. Not even like 3%. Like I think it'll be like 700K still. Like
I was going to say 4 to 5%. So I mean, I'm maybe a little bit more bullish than you, but I completely agree with you that, housing prices, single family detached, are definitely going to go up.
Yeah.
This is going to spark that to go up. But you're right. Like the condo market is probably going to be a bit of a bloodbath for the next year or so here from the investment side, for sure. So that'll be interesting to see. But probably trending back up.
100%. Yeah. Again, and I want to say that's nuanced to the type of product that you're
100%.
looking at. Like they said before, like Toronto has this huge supply of investor condos. So they're like the 400 square foot units. Those are getting obliterated, like pricing wise. The 1,200 square foot condos have continued to rise. They've never gone down.
Yep.
Right? Because they're livable. People are buying them to live in long term.
Stay long term. Yeah.
It's versus a product someone was buying to rent out.
Yep. Exactly. So, yep. Good stuff. Okay. Anything else, Neal?
No. Money's gonna be free again soon.
Awesome. Love it. All right. Thanks everybody for listening.
Talk soon.
Hey guys, it's Neal and Ryan, your co-host and your co-founder at Keystone Capital and Director of Investor Relations. I'm also a real estate agent, real estate investor, and business owner.
And your co-host here, Ryan McNeil. I'm the co-founder and president of Keystone Capital Group. Keystone Capital Group is licensed under the Mortgage Regulations Act of Nova Scotia, license number 3000549, and through FCMB, license number 88799. And keep in mind, the views of this podcast are for informational purposes only and is not financial advice.